Welcome to Brookfield Perspectives, a podcast from Brookfield that explores how the firm invests in the backbone of the global economy. I'm Lawrence Steffi, your guide as we meet the business leaders at one of the world's largest alternative asset managers. In today's episode, we're bringing you a timely conversation between Brookfield CEO Bruce Flatt and Mark Carney, the chair of Brookfield Asset Management and head of Transition Investing. With the global economy poised for big shifts over the next 10 to 15 years, Bruce and Mark will unpack how Brookfield built its business, how its approach has evolved over time, and where it's headed. They'll also touch on the impacts of AI, the green energy transition, and other developments that affect the evolving backbone of the global economy.
Hey, hi, Bruce. Long time no see.
Morning.
It's great to sit down with you.
Always great to see you, Mark. Thanks for taking the time. Good to have you in town.
I'd like to have a general conversation, but really divide it into Brookfield past, present, and future. And in the process of doing that, really bring out what's happening in investing, what's happening in the global economy, and all the exciting opportunities that are to come.
Okay, super. Excited about that.
Good. And of course, probably the most seminal moment in Brookfield past was when you and I first met. You may not have realized that.
I think it was late 90s.
That's right. You got it in one. It was late 90s.
I have no recollection, actually. I have no recollection. I do remember I knew you, but I have no recollection of the day.
Okay. It might have just been into the 2000s. You were becoming the CEO, and the CEO not of Brookfield, but of Brascan, a company with almost a 100-year history. I mean, this is 25 years ago. You were outlining for myself and a few other people from an investment bank, I was working at Goldman Sachs at the time, the potential pathways forward for Brascan. And there were a few paths you could take. And I just wonder if you can cast your mind back. You wouldn't have remembered meeting me, but you would remember this.
Look, I did, Mark. I facetiously say that. Amazing. You covered us at the time, and we still have a relationship today. And it took me 25 years for you to come and work with us. And just for everyone's benefit, Brascan became Brookfield. But we had a very successful investment business, and it was our own investment business. And I guess I was trying to convince Jack and the others and the board at that time that the future really lay in the investment management of the products that we invested for ourselves. So we invested in infrastructure and renewables and real estate and all the alternative products that we do today. We just did them for ourselves. The common thread at the time was, well, if you're going to do deals, there's only a few of them around. And at the time, the private equity industry was starting, and real estate had started raising some institutional money. And we thought that that could be the future of what we did. And so we sold a lot of our businesses we had and used the capital to expand the businesses of real estate and infrastructure and renewables, and then eventually started building out the investment management business. And around the time when we were talking to you, we probably really had no idea what that meant. Because when we started, nobody knew how to do it. Starting off, those first funds, nobody would take them. So it was 100% our money. But we had enough capital to be able to do that. And I think that was really the difference of why we were successful and others maybe didn't have the ability to get it, is we had the capital from the investment business we had to be able to drive the success of our investing. And of course, the teams were disciplined and we did well, and that helped. But having the capital support was really, really important.
If we go over the period roughly of 25 years, or the period since you've been CEO, if I had been smart enough, not just to cover you, but to buy Brascan at the time, Brascan becoming Brookfield share, and reinvested all the proceeds, how would I have done?
Well, look, this is a miracle of compound returns. You can do it in many different ways, but one way to be successful is to not make too many big mistakes, earn moderately good returns, and keep compounding for long periods of time. So our 30-year compound return record is 18%. So that doesn't sound like very much, because 18% doesn't sound like so much. But that's, I think, 13,500% over 30 years. That's a lot of compounding. I think it's 145 times or something like that. And I guess that track record from the top allowed us to build out the business and gave us confidence to do things. I think the total amount of money we've made for public market and our LP investors is $225 billion over the period of time. Look, we're an investment organization and we need to take care of our partners. We need to create structures for them that help them do their business. We need to bring them co-investments. We need to help them in all the things we do. But at the base of it, we need to earn them good returns for their capital. So we've been fortunate enough to do that. And it's been a fun ride too.
It actually brings a issue up, which I wanted to get your perspective on. Over the course of your career, or my career from different perspective, we have crises. We have market events. Markets all of a sudden shut and financing doesn't happen for various reasons. And we have big disconnects that open up between price that you can get in the market or not get in the market and the underlying value of the business. And I just maybe ask you to unpack both managing through market cycles, how you think through time on realizing value in those environments.
Yeah, so I'd say for our overall business, what we need to do is, in anyone's overall business and anyone's individual portfolio of investments, however you want to characterize it, one needs to be in a position where they can at least hold everything they have through any one of those moments in time. And what's really special is if you have some extra cash around to be able to do something additive at that point in time, and that really makes a difference. Our returns over 30 years have been 18%, and they probably would have been 15%. Except for at some moments in time, we were liquid enough to be able to do some special things when the price of something was in the markets far down compared to what the real value was over the longer term. So if you can buy at the right times, it's really additive to the overall long-term returns. So that's our overall business. And then our investment strategy has a number of facets to it. You know this, but I'll say it for everybody, is we're global in nature. We have large scales, and with large scale money, not many people can compete with us. Therefore, we differentiate on transactions. We have our operating skills that allow us to earn more out of assets than other people might. If you take the most basic investment premise of what we try to do across all of our businesses, and this is across private equity, real estate, infrastructure, renewables, credit, everything. What we're trying to do is we're trying to capitalize on the inefficiencies of the capital market. The price of things is often higher or lower, and very seldom is it equal to the value. And therefore, we're trying to be buying when the price is less than value. So when I say buying, we're taking companies private off the public market because somebody's willing to give them to us at 50 cents on the dollar. They give them to you because they perceive there's risk or that isn't the value, which is why those first things are important. Have operating skills, understand the business, know what you're doing, all those kind of things. But we're trying to capitalize on the inefficiencies of the capital market. And then when values are higher, we're selling them. That really is the success of private equity, if you want to call it that.
Yeah, well, absolutely. And if you avoid bad things, life is more fun. You mentioned earlier, one of the strengths of the strategy was we had our own capital, and that capital is compounded and it's grown. And that certainly has been a differentiator. But as you know as well, you took something else from the old brass can, which is operating expertise. And I think that's outside looking in. And one of the many reasons I valued when I was a policymaker, talking to you, a good feel for what's going on in the world, not just where it is, but where it's going, but also an on the ground sense. Not just what's happening in public markets, but what's happening in companies and countries and where they're going. So that operating expertise has been, I think, distinguishing.
Yeah, methodically, there's a few people in the world I always would go and see. I still do this today. People I respect, and you can get a different sense of information out of them, and you were one of them. You would know this in hindsight. When you went to, you're at Goldman, you covered us, we sought your advice. You went to Department of Finance, we sought your advice. You went to the Bank of Canada, we sought your advice. You went to Bank of England, I visited you once a year. So it was probably 25 years of listening to your advice, and you always had unbelievable, thoughtful comments for us on what was going on in the world. So I'd say that's why we're here today. And look, the difference we have, and it's not better or worse, it's just different than most investment organizations. Our business is different because it started as we wanted to buy hydro plants and renewable plants, and we wanted to build infrastructure, and we wanted to own and build and buy real estate. And we did it ourselves, and we did it with some of our money. When we ran out, we raised other money, and then we raised funds. And it was to facilitate the operating and building of our businesses. To do that, we had vast operating groups, and we think of it as we're running a business, and how do we source the capital to run the business, as opposed to we're just in a fund management business. And I think that's always changed the tone of how we deal with our clients, how we deal with the businesses, how we run them, how we build businesses. And that DNA in the organization is still here today. Of course, we're a large investment management organization today that we've built. But I think that DNA of having the operating skills and people, and just as an example, is our renewables business. We have one of the largest trading desks for power in North America. It sits down here in this office building. And we trade enormous amounts of power. And what that means is that we're close to the markets. And we probably have more information to inform our decisions than almost anyone else that invests in the power business. There's a few, but most of those are single industry businesses that just do renewables. We have enormous amounts of capital. We're very global. And we have those operating skills. And I think that allows us to be different and makes us better investors. And look, business is tough. Life's not easy. You get into problems and you get tough sometimes. And having that extra information or legs or people to help you out make decisions and get out of tough situations is always really, really helpful.
Yeah. Well, it's crucial to have solutions that aren't limited by just financial engineering or access to capital. Let me just stay with renewal and bring us to more or less the present. After I finished my career in public service, and I had in my head was that transition was going to be a major opportunity because the world was starting to get really serious about moving towards net zero. This was the time in the run-up to the Glasgow climate meeting. And I'll be blunt, in talking to a number of major financial institutions, including some in this industry, nobody else saw that or saw that to that same scale. You and Connor and the rest of the team were way ahead of it and absolutely saw the scale of the opportunity to build it out. So I came and joined, and we helped to almost create transition as an asset class. So not just the end state, but the process of solving the issue of getting carbon out of the atmosphere and creating a lot of value as a consequence. Fast forward to today, where being low carbon is becoming a big driver of value. And I think that will go forward. But the point I wanted to just put on the table, that this was about 4 years ago that I came in.
It was in the heart of COVID.
Yeah.
I remember many phone calls from my bedroom.
Yeah, exactly, where you were hermetically sealed.
I was in the basement. Yeah. That was crazy times.
It was crazy times.
But yes, we did two things in the middle of COVID, which will have changed the face of our business. You helped us form the strategy for transition, which I think we are the leading business in it today. And I think it'll change the face of our company for a long, long time. And secondly, we decided to start our insurance business. Those two things, I think when you look back 10 years, 20 years from today at this business, those two things will be as strategic decisions as getting into asset management 25 years ago. So I think you don't have to make that many big decisions in a company. But if you make a few successful ones and then you execute really well and don't stray, it can be highly, highly strategic. And I think our insurance business is going to back growth of very significant amounts over the next 25 years as really just the amount of money in defined benefit plans and in saving plans that needs to earn a decent return and that can't take too much risk and we can invest it for them is very significant. And the complexion of portfolios changing to be net zero as we all decarbonize, being a leader in it has been instrumental for our institutional investors and also taking out terminal value risk. I think the biggest thing you brought us to was first, I'd say, forming the strategy of what we were going to do in transition because we had an idea, because we had a renewables business and we were ahead because we were thinking about it. But you helped us a big way to form the strategy of what we were going to do. But it also helped us, you opened our eyes probably earlier than everybody else to the terminal value issues if you weren't going to be decarbonizing. And that was significant for us.
This is an enormous shift of capital investment, shift in the backbone of the global economy, which is the core strategy of Brookfield. So maybe just ask you to reflect a bit on that because there's transition. There's broader infrastructure, is what's happening in AI and digitization, just how you see those trends coming together.
You know, Mark, look, I'd say sometimes you get lucky, sometimes you work hard at it, sometimes both. We are lucky. We're in the heart of infrastructure. We were there very early. We're the biggest in the world. We're leading in decarbonization. So we're at the intersection of an enormous number of trends today, which are going to change the world. The backbone of the global economy is shifting, changing. It's all the time is shifting, but it's shifting even more. Over the next 10 or 15 years, it's going to be dramatic. And the amount of investment that's going into those trends, decarbonization, digitalization, and third, I'd add the deglobalization or the reindustrialization of Western economies to bring back because labor costs are low and different things like that. But the amount of money that's going to be invested is tens and tens, and not hundreds and hundreds of trillions of dollars. I don't even know how. Those are really big numbers.
They're big numbers, yes.
But the most interesting thing is that the investment of that money is going into the advancement of artificial intelligence, robotics, and many other things, which are going to change the productivity of businesses to pay for it all. I think what's most interesting is we may be on the cusp of, you know this better than anyone as a sophisticated financial economist, but we're on the cusp of an investment boom for 25 years. Because if you spend money and you don't get any returns out of it, it's a terrible thing for the economy. But this investment is possibly highly, highly productive and is going to lead to productivity advances in virtually every business in the world. And therefore, it's going to be highly productive and lead to growth in GDP. And I don't know if I'm not a macro economist guy. I'm just a working guy down at the grassroots.
You just make it happen.
I'm just a plumber.
You make it happen, and then we macroeconomists take credit for where you make it happen. That's the way it works.
The U.S. is it in even greater scale, and it's happening in China, and it's happening in every country of the world. We're on the cusp of something highly, highly meaningful and productive for the world.
I think that's exactly right. And the benefit to economies that get this right is multiple. One, you're building infrastructure, so someone actually has to put the shovels in the ground and build out, whether it's a solar array or it's a data center for AI, because the AI data centers, all the hyperscalers want to be powered by clean power. So you have the benefit of the actual physical investment. But then, as you're saying, you get the benefit of the productivity.
You see, Mark, that's the thing. People think about AI and they think about ChatGPT. What hasn't been done well is that people don't understand the next step. The next step is utilizing that information and that data and the data center and what's there in the algorithms to then make businesses more productive and better. So, for an example, we make car batteries. We have 25 plants in the world. We make a third of all car batteries in the world, which is an amazing business. Yeah. But the application of artificial intelligence to some of the manufacturing capacity will make us better, faster, cheaper, and will take out tasks that people don't want to do. The health risks are high and different things like that. So you can make your workforce much more productive, and you can make it healthier for them to do their jobs, which is really, really important. And so we're changing people's lives in many different ways, and you're getting productivity advances with it. And you take that in all of the different businesses that we have, and it should lead to enormous productivity advances, maybe as much as what the internet's done over the past 25 years.
I think that's entirely plausible. And better companies, better run companies will see those gains earlier, and then others will imitate. It's realistic that we see another, let's go back to the miracle of compounding. It's realistic that we see another 75 basis point, 3/4 of a percentage point, additional growth, let's say in the US year in, year out, because of the application of AI within a broader universe of allocation to alternatives. The most sophisticated institutional investors in the world, some are sovereigns, some are pension funds, have steadily increased their allocation to alternatives from very low single-digit percentages up towards, in some cases, half of their portfolio. These are long-duration liabilities they have, and there's a great match, and the returns are very strong. That hasn't been the case in general for insurance companies who have the same challenge. And we'll come to this. It hasn't been the case, only to a very limited extent, to retail and high net worth individuals as well. So starting with insurance, just get your perspective, Bruce, on where are we in that journey? As you referenced, one of the big strategic initiatives that Brookfield has taken in the last few years is to build an insurance business, and it's early days, it's early innings in a much bigger trend, don't you think?
Mark, I think maybe the way to put this and the way to think about it from a big picture is it's now been unequivocally proven with 25 years of track record that investing into alternatives with good people and with investors that know what they're doing is both a diversifier in a portfolio, takes down the volatility, and you can earn very good returns over the longer term, well in excess of what you'd earn in the public markets or in public credit. And because of that, that's why institutional investors, as you note, are pushing money towards these products. Insurance companies are the next ones looking at it because they're having a hard time. Our view, the reason why we went into insurance is when we do things ourselves, we always are better for our clients. We know exactly what their issues are. We can create products, and you never, ever, ever know it fully until you do it yourself. So we want to have an insurance business that we create a product for ourselves that then we could offer our clients. In addition to that, look, our expertise is in investing, and therefore having the ownership of an insurance company is kind of like, as long as we can manage the liability and we're trying to do low risk insurance, we can usually out-earn anybody else. And therefore, if we can buy companies and then out-earn on the asset side, you can make up very high returns to the bottom line. And most insurance companies in the past have struggled with the investment side of the balance sheet. That's our core business. So it's just sort of an addition to our overall business, and it gives us some money to put to work into the strategies we have in asset management.
Yeah, let me pick up on just a couple of things there. One is that when I was at the Bank of England, yes, we were the new regulator and supervisor of the insurance sector. So fourth largest insurance sector in the world, based in the UK. So big responsibility. We inherited a regulatory system that had been heavily negotiated as part of the European Union process. And as part of that, it has a structural flaw, which you alluded to, which is very much limiting what these companies could invest on in longer term, so-called duration matching their longer term liabilities, not exclusively, but largely to gilts, government bonds, which is, boy, you've got to set aside a lot if you're trying to meet 25, 30-year liabilities, earning at the time 1 or 2% on the 30-year gilt. That problem is now recognized. In Europe, it's recognized in the UK, and it's recognized by other regulators to varying degrees. The US, as you say, is out in front on understanding that some of the best assets are long duration infrastructure type assets that are housed in alternatives. Better return and well-managed credit. Those are the two asset classes that look to, and I think the industry as a whole will be moving in that direction. So it's a trend that's early stage, and it will move, in my judgment. It's going to move naturally, and there'll be some step change improvements in it over time because the regulators are going to catch up. It's one of the biggest policy issues in the UK right now. The last point on it is that there's two beneficiaries of this. One is the citizens of the country, because you get more investment on the ground, for example, in the United Kingdom, in the type of infrastructure assets we're talking about, decarbonization, digitalization, et cetera. And then ultimately the policyholders as well, because they're more likely to get a better return. They're going to get a better priced product, and they're going to get paid because these are high quality assets that are going to be there 30 years from now to pay them off. So it's a huge development, huge structural development, and hugely exciting.
And Mark, I think the next phase of that is, you asked earlier about private wealth. The next phase of it is we haven't scratched the surface of delivering these products to private wealth investors. We formed our wealth solutions team to deliver those. We've got a big team that now is, and essentially really what it is we need to be able to create structures which are just a little different to be able to deliver them to individual investors. We're investing in the same things. It's just the wrapper around them and the structure we have. It's just different. For an institutional investor, it can be this way. For a private wealth investor, they need to have it this way. But we're on the early stages of very significant amounts of alternatives being brought to individual investors, and that's going to grow over the next 25 years. So it's going to be a big growth area for alternative investors.
And a huge benefit for those individuals and their families and down through generations.
I'm going to ask you a question.
Yep.
You're a macroeconomist. The efficient market hypothesis says that everything's efficient and the market knows all information is out there. And I think that's worst. It's been disproven hundreds and hundreds and hundreds of, every day it's disproven. And there is no efficient market. But as a macroeconomist, like, what do you say to that?
I think there's a couple of things. One is you have, and you alluded to one of the most important ones, which is not everybody is managing their portfolios and businesses with the liquidity and the ability to ride out cycles. There's leverage. People get margin calls in all senses, and they have to react to that. And then others react in anticipation of that happening. I mean, we get into pull in macroeconomics. Keynes famously said, your opinion is not what the average opinion is going to be, but what the average opinion thinks the average opinion is going to be, right? So it's multiple. So you get those cascades that work their way through a market, but you also get, and we see this, periods of euphoria and despair. And that actually brings me to a point that I wanted to pull things together, because I think it might be helpful. And this is a little window into the investment process that you oversee with the investment committees, and I think is core to the ethos of Brookfield, is you need to combine optimism about where the world's going and what's possible and what can be created with disciplined pessimism about what can go wrong. And one of the things that I always had a bit of a sense of this from our discussions over the years, but absolutely have seen day in, day out at investment committee, is the focus on flooring the downside, understanding what can go wrong, of not investing when those risks are too great, but not being incapacitated by it. Obviously, we're not incapacitated. We have $1 trillion under management.
Invested $50 billion last year.
Exactly. Yeah. So how do you see that balance?
There's a fine balance. And the real big decisions, we try to keep it with a small group of people that we can stay in touch with and understand the markets. We train our people to not try to shoot for the lights out and to show us what the downside risk is. Look, once in a while we make a mistake, but in addition, don't be diversified. Don't make those mistakes ever that one of them is going to cause any fund to be irreparably harmed, any business to be irreparably harmed, the overall business obviously to be irreparably harmed. So focus on downside protection, and very seldom do we ever not get our money back, for example. Even in a bad investment, we get all our money back. That's not our business. Our business is about, in the worst case scenario, not worse because there's always a few bad ones, but in the worst case scenario, you get an 8% return and it didn't work out. That was your downside. And so we try to stress the downside, which you see in our models. So we're focused on the downside protection, like what can go wrong and how do we ensure that we're at least okay in the downside? And if we can't make it, we'll find another investment. Look, I think the success of our business is it's diversified. We're in 30 countries. We can actionably, with people on the ground and knowledge, we can put money to work in 30 countries and in 25 different types of businesses. Therefore, we don't have to do anything. We'd like to do lots of things, but we don't have to do anything. You're not forced. Where troubles come in investing is when money is trapped and needs to be invested in a certain thing. So I think that the diversification and having many places to put money and investments to make and allowing yourself that flexibility has been a great, look, it cost us a lot of money for 25 years to be able to build the resources to be able to do that. And that's the moat we have. The moat we have is we have an enormous organization that's been trained to do what I just described. It's on a global basis in 30 countries. This is not easily built. You see us now every day, the relationships we have, the people we deal with, the business issues that come along, the things that we can do for our clients, those aren't things that come to somebody overnight.
Yeah.
There will be one or two other maybe businesses like ours that are built in the next 20 years. There's 10 that are mid-sized and one or two might get as big as the 5 of us that are this large, but there's a big moat that a number of us have.
And in the process, our investors are realizing those compounded returns, means that pensioners get paid their pensions, life insurance policies pay out, people can sleep at night, and in economies more broadly, they're building the future. That's what is so energizing about this.
Yeah.
You actually see it tangibly, what's changing.
Mark, I'm glad you hit on that because it's private investing. I don't know why people came up with this. Some people don't like it. But what we do for the constituents, our partners, is that we allow them to earn higher returns and not take so much risk. And therefore, they can pay greater pensions. They can save for the country. They can save for
future generations,
future people.
Yeah.
And it's game changing. You know this. When you compound at 5%, you compound at 10, it is dramatic over 50 years. And many of these investors that we're investing for, or families, this is for 50, 100, 1,000 years for sovereign plans. And if you can just add a few hundred basis points of return, it'll change the lives of many.
Yeah.
And therefore, it's a pretty special thing at the end of the day when you can do that.
Well, great way to end it. And thanks for the time, Bruce. Always a pleasure.
Mark, thank you.
That's all for today's episode. Thanks to Bruce and Mark for sharing their perspectives. To hear more from business leaders at Brookfield and beyond, check out our other episodes on decarbonization, deglobalization, and digitalization wherever you listen. Be sure to follow this podcast so that you'll get updates on new episodes of Brookfield Perspectives as soon as they're released.
Audiation.